Happy Wednesday, and thank you again for joining us for another session of RM Smart Investing. Today, with the exciting markets that we've had, I thought following up on our crude oil uh, class last week, and we briefly talked about the Western Texas Intermediate and then the Brent oil. Briefly, I mentioned about looking at the divergence of those, and I thought this week would be a good follow-up talking about pairs trading and how we can take advantage of these pairs trading, especially when you don't really have a direction in the markets, or you don't really want to get involved as far as having a bias and taking a position. So the pairs trading can be attractive, and because there's quite a bit in this, so what I thought, we will have two parts today. I'm just going to have an introduction so you get the concept of what that means and where we can apply this, what instruments we could use. And following week, it's going to be probably much longer. We're going to get to the meat of it. We're going to talk about actually the criteria, and we will have examples, what mechanics, what strategies we could use in different environments. So I thought that will be worthwhile actually attending next week. But putting them both together would have been a very long class. So I thought, let's break it down. Let's first have an introduction and actually find out, when we say pairs trading, and sometimes we can even talk ratio trading, what does that mean? Basically, the pairs trading, there's two positions. One is a long position and the other one is a short position. So basically what it creates a market neutral environment, a delta neutral. So in reality, what we do, we are buying the undervalued, we go long, and we are shorting the overvalued or going short. So in this situation, again, the idea is they kind of wash each other. One of the criteria is which is very important. You want to use the underlying assets which are highly correlated to each other. So that's a big criteria, and that's one of the, again, issues that we want to pay attention. The other thing is also, once they're correlated, let's say in a stock market or any type of commodities, you want to make sure they have a similar underlying economic factors and or fundamentals, such as the environment they're in, they get affected equally, whether it is the softness in the economy, whether it's the sales, if there are stocks, there are the similar sectors, similar industries. So that's very important. So that's one of the reasons we pay attention to correlations. Again, this works when you put the position in, it kind of allows you to be trading in a market neutral position. Although next week when I'll talk about it, it could become profitable. Even you could, if you wanted to take this further, when you see a big spread between these underlying assets, you could maybe have a bias and buy the undervalued and just cover the short side and just continue with that. But generally, when we talk about pairs trading, we want to have two positions and close them together if possible. The other thing is it's important is a hedging strategy. So I call that repair strategy. And sometimes maybe you have positions, they're going against you. And what you could do, and I will use an example on futures, for instance, next week, what you do is you actually use the correlated assets to correct it. And I will give an example on the mechanics of it, but a short example, which will look at the assets. Let's say you have S&P 500. Based on your 60 minutes, you have the conviction that it is a short. It's like basically what you have done. Your studies, you look at the charts, but on the shorter term, it is going against you and it's going to hit your stop loss. So what happens is you really don't want to, pretty convinced that your anchor is correct, your 60 minutes is correct, and you don't want to do multiple tradings. So in order to repair that, for instance, you will buy something correlated, probably NASDAQ or Dow, and you use like a 5 minute. So this way you use a correlated, and once the short-term trend runs its course and it goes back to your long-term trend, then you basically take your profits and continue with the original trend that you believe in, let's say shorting your, in this case, S&P, E-minis, for instance, then that's a repairing. So that's part of, again, pairs trading. The last but not least is, again, this is suitable for, you could do day trading, but also swing trading and investing. And again, you will be able to use different asset classes. So what are the advantages? As I mentioned, it is something that, because of, again, we're talking about long and short, it reduces your risk and losses. And I just mentioned, for instance, with the S&P E-mini and NASDAQ, it can really reduce your losses without really hitting your stop loss. Also, it has a profit potential because of depending on the movements. Sometimes maybe the long side moves much faster than the short side. So it allows you to have a profitable trade. And we will discuss that next week on your risk and reward. What is your profit target? What is your risk target? And basically, it's usually 1-to-1. So you could have a profitable trade with these pairs trading. The last but not least is the hedging. And hedging is really main reason that this thing happens, that, again, you go to a market neutral. You really don't know which way it's going to go, especially when there are big events coming up and you want to be in the market. You don't want to sell your thing. So this is one of the ways to be in the market, and by using the pairs trading. So the beauty of this is, when we talk about asset classes, this pairs trading applies to individual stocks. You can use it for futures. You can use it for ETFs. Are wonderful. ETFs allow you to use the liquidity and play around that. So ETFs are very good, which I will give you some examples. Options. You can use options on underlying futures or stocks or ETFs. So based on the capital, it works out very well. As a matter of fact, on options, we'll have a strategy which is called split iron condor. And you will see how you can actually use pairs trading and set up an iron condor. So there are different ways you can use options for this. Currencies, there's some correlated currencies, like, let's say, commodity, or like even oil commodity trade, commodity currencies. You could use currencies. Bonds, I mean, this is attractive. So you can see what is happening right now. You have this big spread between short-term and long-term, between 2 and 10. Even you look at in 6 months and 1 year T-bills, and you see you can actually structure a strategy based on bonds, short-term bonds and long-term notes, and short-term bills and long-term notes and bonds. Also, this is new. We don't have a lot of history, but you could also, if you're aggressive, then you can use cryptocurrencies, whether it's Bitcoin, Ethereum, or Litecoin. So that's also another, as far as idea that you could choose as far as asset classes. So what some of the disadvantages that we have to pay attention to is, again, we are basing this on the correlation of these assets. So basically, we want to make sure there's a high correlation, enough that it gives you advantage. So you don't want to have low correlations, which defeats the whole idea. So the idea is based on historical correlation. So we might have to make sure there's accuracy, there's enough data, and that's what it's a little setback with, like, cryptocurrencies, for instance. So you want to make sure there's accurate correlations. The other thing is the price fills. So sometimes, when you put your trade in, sometimes it doesn't go at the same time. It doesn't get filled. There is, again, that price gap. So that also becomes a disadvantage. Remember, you're using two different assets. The other part you have to really pay attention, especially when it comes to in this situation, for instance, if you're using stocks or some kind of things that you have to be concerned is adverse movements. That's why we don't want to use it, for instance, right before before the earnings or big news. There's a chance of default. Let's say if you're using specific bonds or there's bankruptcies. So just be careful what is the underlying asset that you use. So that becomes adverse movement because your short can continue, but it has its own classification in the sense of whatever stock that you're using. The other one, if it has the long, if all of a sudden there was this adverse news, then that will go down. So your short will make a little bit of money, but that one you will lose a lot. So these are the setbacks, and you have to be very careful on choices of your underlying. Now, one thing you want to pay attention is, again, the correlation plays a big role. You want to have assets that are very much related to each other. And I just thought, just statistically, what correlation is, or correlation coefficient we call, is basically this coefficient goes from -1 to 1, and 1 is they absolutely correlate to each other and they move exactly the same way, and negative is complete opposite. And basically that's something that you can apply to as far as understanding that they're going to go most likely opposite. As 0 means there's no correlation. So that's why you want to pay attention to the correlations. So this, I think, probably will make it a little, hopefully much more clear. Some examples, as I mentioned, the futures, you have the S&P 500 and NASDAQ. They generally move together, but you have to pay attention to the implied volatility as well. So NASDAQ could have much more diverse movements and related to S&P, but generally they move together, but you will have some divergences, and that's what we want to take advantage of. And as I mentioned, it could also be a repair strategy. How about stocks? How about Walmart and Target? How about Coca-Cola and Pepsi? In the futures, in precious metals, how about gold and silver? We look at the history, we look at the ratio, and basically that's actually a good trade, which we'll discuss next week. How about Exxon as a stock and XLE as an ETF? So they generally move together, but sometimes they do have then the moving away from each other, and that's what we look at the ratio analysis, for instance. So that would be another one. How about last week we talked about the Western Intermediary, WTIC and Brent. That's another idea. Home Depot and Lowe's. How about fast and fast? Triple, we talked about inverse financials versus the leveraged financials. These are really short term, but that would be another idea. Corn and wheat in agriculture futures. How about HYG and JNK? The junk, these are high yield bond funds, then ETFs and junk. About TLT and SHI. TLT is a 20-year average ETF bond holdings, and then SHI is 1 to 3 years. So we have the short term, long term. We look at the ratios and we see which one is more attractive and to go long, and which one is less, we go short. And of course, the OIH and XLE as well, the services in the oil services and then energy. So these are some of there's just many of them. I just wanted to just give you a little introduction in the sense that knowing that how many available options you have, and literally you can choose underlying assets. So the other thing you have to take into consideration, what we're talking about, is the concept. And what is the concept we are really relying on is, as I mentioned, when we have movements going away from each other. So basically they have been having good correlation. All of a sudden, one asset is taking off, going different way from the historical relationship they've had. The other one is going the different way. So we're getting a big gap, which again, next week I'll show you how it is possible to find these, how we can screen for these. The easiest way would be like the ratio, that all of a sudden one becomes really overvalued. The idea of the whole thing is historically everything is the mean reversion. That means, once something goes really up, eventually it has to come back to its mean. The same thing when there's something is undersold, undervalued, and it's oversold, it eventually comes to the mean. So understand that mean reversion. The historical volatility also we want to take into consideration the relationship between the assets. You want to look at the historical volatility. Now, the implied volatility becomes important when we are actually choosing the number of contracts, for instance. I mean, S&P and NASDAQ, they don't look the same. Exxon and XLE, they don't have the same price. So how many contracts we have to do? Do we go one-to-one? We have a gold, which is, when you look at gold, let's say it's at 1700 and then silver is at 20. Do you go sell one silver? No, there's these ratios. So how do we know how many contracts we have to get so they become really delta neutral? And that's when we pay attention to implied volatility. And that's the other thing is the ratios. We could do, for instance, talking about ratios, we've done, again, mentioned the crude oil like WTIC and Brent oil, but also in the ratios, you can do gold and silver. How about Russell value and Russell growth? So small cap value, small cap growth. These are all the different things we can take a look at and make a judgment whether the correlation is good enough to go into a pairs trade. We look at the relative value or relative strength, and that's again one of the ways of looking at which one is overvalued, which one is undervalued. So these are some of the concepts. Once I give you the examples next week, I think will be more clear, but I just wanted to make sure you have the foundation once we use the examples. One good thing is there's quite a few platforms that you could use for pairs trading. Thinkorswim actually has a study you can use for the pairs trading. I'll share with you next week. They do have the correlation indicator. The same thing that in TradeStation, they have relative strength. So there's different ways we can actually have a nice chart set up for us without really writing a program. So stock charts allows you to do the ratios, for instance. Thinkorswim allows you both. You can actually I've used minus, so you can see that the spread, the difference between the prices. Tastywork actually has set up a special order link that you can do. You choose your it has an ordered box for you. You can do the pairs trading without really putting any effort, really not much effort. You just say, well, I want to sell GLD and I want to buy SLV. And these are the number of contracts. It calculates the risk, implied volatility. So there's a lot of good platforms out there that you could use. These are the main ones that we've been using. So I thought I want to share those with you. So basically, we are fortunate that we have that. So anyway, I just wanted, this was a very short and sweet introduction. I want to, hopefully you get the concept, and hopefully you're more curious to see what can we do with these. And again, just for interest of the time, and because it will be a lengthy class next week once we get into the futures, the options, the ETFs, the stocks. Each one has its own relationship, even corn and wheat. The other things you can do options and the futures, which are very popular. So all of these, I think, are attractive. It's just, I thought, let me open the door. Let me get you interested in hopefully learning, asking for more learning and education, and then you can apply it. So that's about it. With that in mind, I'm gonna stop recording and